Everyone, and welcome. Today, we're going to decode a really powerful signal that's often hiding in plain sight on a trading chart, the Doji Candlestick. Now, it might look pretty small, maybe even insignificant, but trust me, as we're about to see, it can be your first clue that a market's direction is about to make a massive change. I know, it sounds almost too simple to be true, right? But what I've learned over the years is that some of the simplest signals are actually the most profound. So let's jump in and see how this one specific little shape can give us a critical heads up that a trend is getting ready to turn on a dime. Okay, so before we start breaking down all the different types of doji, we first need to get a solid grasp on what every single one of them represents at its very core. And really, it all boils down to one simple but powerful word: indecision. So what is a doji exactly? Well, structurally, it's just a candle where the price opens and then closes at almost the exact same level. I mean, think about that. You've got a full session of trading, all that buying, all that selling, all that action, and at the end of it all, it's basically a draw. Neither the buyers nor the sellers could really take control, and this right here is the whole point. A doji is basically the market's way of slamming on the brakes and hitting the pause button. It's this moment of perfect balance in that constant tug of war between the bulls and the bears, and it shows us that whatever momentum was there before, well, it might be fading. And here's the real secret to using the doji's power. Think about it. If you see indecision in the middle of a market that's just chopping sideways, it doesn't really tell you much, does it? The market is already indecisive. But what if you see that exact same indecision at the very peak of a massive rally or at the absolute bottom of a steep sell-off? Well, now that is a huge red flag. This is why you'll hear traders say over and over that context is everything. After a really strong uptrend, a doji suggests that the buyers are finally getting tired out. And after a long, painful downtrend, it hints that the sellers might just be running out of gas. This is the exact moment when that tiny little candle transforms into a powerful reversal signal. Alright, so let's look at our first specific type, the gravestone doji. And yeah, that name alone should give you a pretty good hint about its ominous signal. Just take a look at its shape. It's basically an upside-on T. You've got this long wick sticking straight up and a tiny little body right at the bottom. This very distinct visual tells a really specific and bearish story about what just happened in that trading session. So here's the story behind it. During that trading period, the buyers managed to push the price way up. That's what creates that long upper wick, but they couldn't hold it there. Sellers came in with overwhelming force, and they slammed the price all the way back down to where it started. They decisively won that battle. It's a powerful signal that the uptrend could be over. Rest in peace. Now let's just flip that whole concept on its head and look at its bullish twin, the dragonfly doji. This one signals a bit of hope after a downturn. And you'll see it's the exact opposite of the gravestone. This one looks like a perfect T, with a long wick pointing down and the body sitting right at the top. The story here is a complete mirror image. The sellers, they gave it their best shot, pushing the price way down and creating that long lower wick. But then the buyers stepped in. They soaked up all that selling pressure and drove the price right back up to close near the high. Now, after a long sell-off, this can be the market saying a bottom is in. But, you know, smart traders will often wait for the next candle to close higher just to confirm the reversal has really started. Okay, our third type is a little more nuanced. It's the long-legged doji. And it really represents a much more balanced and, because of that, a much more uncertain fight. Its shape is pretty much a cross or a plus sign. You see, the open and the close are right near the middle of the candle's range, and it has a significant wick on top and on the bottom. So, this candle shows us that both the buyers and the sellers made a really strong push. The price went high, it went low, but in the end, it finished right back where it started, in the middle. This is like peak indecision. And because it could be a major reversal or just a quick pause in the action, the big takeaway here is you absolutely have to wait for the next candle to see which side wins the war. Okay, so we've broken down the three main types. Now let's just put them side by side so the differences are crystal clear, and then we'll look at a real-world chart. Alright, so let's do a quick recap. The gravestone with that long upper wick tells us the sellers won. That's a potential sell signal. The dragonfly's long lower wick shows us the buyers won, a potential buy signal, or maybe a good time to cover a short position. And the long-legged, with wicks on both sides, that signals a true battle, telling us, hey, be careful and wait for confirmation. Now let's see this in the wild on a live chart. Take a look at this 5-minute time frame. We see this really steep sell-off, right? 7 red candles just plunging downwards. Then, right there at the bottom, what do we see? A long-legged doji. It signals that exhaustion and indecision right after a strong trend, and sure enough, the market pulls a sharp V-shaped reversal and just rallies. And the story doesn't even stop there. After that first rally, look, another doji appears at the top, and it triggers a pullback. Then, right at the bottom of that pullback, there's another one, signaling the next move up. It's almost like watching a pinball machine, when the dojis are the bumpers at the extremes, just reversing the price direction again and again. It's a brilliant example of their power. So, if you remember just one thing from all of this, let it be this. A doji just kind of floating around in the middle of a sideways chart, it doesn't mean much. But a doji that appears at the extreme end of a strong move up or a long move down, that is a signal you absolutely cannot afford to ignore. Ultimately, recognizing these patterns just becomes second nature with practice. The more charts you look at, the more you're going to train your eye to spot these formations and just instantly understand the story they're telling. You'll see that moment of indecision at a market extreme, and immediately your brain will recognize it as a red flag for a potential reversal. So now you have the blueprint. You know what a doji is, you know what the different types mean, and most importantly, you know why context is the key that unlocks their predictive power. The signal is right there for you to see on the chart. The only question left is, what are you going to do with that information?